Hey, are mortgages going to get harder to get in Canada in 2025? Absolutely looks like it. Here's the change. Bank Regulator OSFI, the Office of Superintendent of Financial Institutions, long name, old-fashioned. What's a superintendent anymore? Anyway, that guy, boss is Peter Rutledge. He's decided that he is going to add a new layer of difficulty to getting a residential mortgage in Canada. What's it all about? It's a kind of an income test. So the concept is a multiple of income versus the amount of the mortgage. So 4.5 times the income of the applicants versus the mortgage amount. Applicants make a total of 100 grand, that's a 450 mortgage. Applicants make 200 grand, that's a 900 mortgage. That's really simplistic, but that's what it's all about. So is it meaningful? Well, yes, but maybe only to a certain group of people. First of all, you might say, well, that sounds like a big multiple anyway. You'd be right. But the people who are really affected by this is interesting. It is very interesting. First of all, let's give the quick disclaimer. This does not apply to any mortgages through CMHC. Now, before everybody goes crazy and says, oh my God, the CMHC, I mean, it's terrible. I mean, what are we doing there? We've got to be more careful with CMHC. Look, relax about CMHC. CMHC has, when I started in the mortgage business decades ago, CMHC represented about 45% of all purchases. It's down to about 18% now, those kind of insured mortgages, not just CMHC. It's Genworth, Sagen, CMHC, Canada Guarantee, those are three insurers. But the whole marketplace of these, what we refer to as high ratio mortgages, it's just declined and declined and declined as the prices have gone through the roof, okay? It's because the maximum is $1 million. So bottom line is, there ain't many of them. Down from almost half of all mortgages 30 years ago to about 18% today. And in British Columbia and Ontario, down to about 11 or 12%. So it's a small part of the market now in the key provinces. So that's excluded, but it doesn't matter. Now, who does this really affect? Who will this new change, this new guidelines, who will it affect? It'll affect people with a bunch of mortgages. That's who, okay? It'll affect people who've got cottages, people who've got rentals, because it's 4.5 times the whole universe of mortgages that people have. 4.5 times their income. So they got a mortgage on a cottage, got a mortgage on their own home, got a mortgage on a rental. It all comes together, and that may not work. So what's it mean? It means that people buying additional properties are going to have it much harder in 2025. That's the greatest likelihood. And it's also going to mean that some of those people are going to be trapped in the renewal cycle. What's that mean? So if you can't qualify anywhere else, you will always be offered a renewal, provided your mortgage is not in arrears. You will always be offered a renewal by your own bank, the bank you have the mortgage with right now. When the renewal comes up, they will send you an offer. Typically, you should be able to shop. You should be able to shop around, try to get a better rate. But these new rules, once they come into play, they will likely restrict people with more than one property. They're going to be stuck with that existing incumbent lender. So how's that for competition? It's terrible. It's terrible for the consumer. But remember, Peter Rutledge, the superintendent of financial institutions, they only care about banks. They're only here to look after the solvency of banks, just make sure our banking system is safe. They could care less if the consumer gets ripped to shreds. That's just not their job. They don't care. So is it good for the consumer? Probably terrible. Really, on renewal, if it should be excluded anyway, but that's another day for another story. So what do we got to think about this? We got to think about that buying new rental properties is going to get tougher. Sure, there's rental offsets, absolutely. And this does not apply to commercial rental. Like we're talking like ones and twos, like you want to buy one condo, one semi, one townhouse, just buying one piece of property at a time. That's going to be a lot harder to do because it's, even though there's offsets, the offsets are not 100%, and there will be some sort of cutback based on the fact that you've got to relate your income more to these multiple mortgages. So there will be less opportunity for investors to buy rental homes. there may be less opportunity to purchase cottages. And there certainly will be some people trapped and to say they have to keep renewing with the same lender because they won't be able to go elsewhere to get a better deal. So that's the general outcome. So is it a good thing, a bad thing? We're going to have to see how it shakes out because this is not individual. Like the stress test is individual. We look at the stress test on each individual borrower. We add 2% to the actual rate to determine how we calculate the debt ratios. That isn't true with this stuff. This is portfolio based. In other words, the regulator looks at on a quarter by quarter basis, like what's happening maybe month by month. Is the portfolio respecting this guideline or is the portfolio going outside the guideline? There's also some room for exceptions depending on certain types of high asset bank customers. But in reality, it's going to be a drag, and it's going to mainly be a drag on people buying and renewing rentals.